Everyone, I'm Laurent Deville, Professor of Finance at EDHEC Business School, and tonight I will be hosting this episode of the EDHEC Business School Future of Finance Speaker Series with Professor Pedro Matos from Darden School of Business at University of Virginia. Before we start, I'd like to wish you all an amazing year 2026 and send my thanks to Emmanuel Jorzenko, who created this series of talk and secured the lineup we have this year. So to get back to today's topic and speaker, we have Pedro, and Pedro's research has focused on institutional investors and their impact on financial markets. His research has been published in top academic journals, but also regularly featured in the press. And I do think that highlights the relevance of his work to companies, markets, as well as investors. And today, Pedro is going to talk about the green transition, a topic that has become central in his research activity. And thank you very much, Pedro, for being here with us. After your talk, Pedro will have the chance to start a discussion with Professor Theodore Diakov from EDHEC Business School and one of our amazing students, Niall Kirk, from the MSc in Climate Change and Sustainable Finance, a joint program that we run with École des Mines Paris PSL Engineering School. So good evening to all you three, Pedro, Theodore, and Niall, and thanks a lot to be with us tonight. Without further ado, Pedro, well, the floor is yours for the next 30 to 35 minutes, after which we're going to have a collective discussions together on your topic. Thanks a lot.
Great. So thank you. Let me know if this is coming through on your side.
This is perfect, Pedro. You can start.
Perfect, Laurent. Merci beaucoup. I was, good afternoon, good evening, or wherever you are. Thanks so much for the invitation. Very excited to join the EDHEC speaker series here. So before I present the research on green transition that Laurent mentioned, I wanted to take a step back and place this in context and talk about why am I looking at this topic from a finance perspective, and particularly the role of capital markets can play in decarbonizing and greening the economy. So what I'll do is I'll speak about the role of investors in influencing the environmental dimension of what we call ESG. So this first part of the webinar today actually built on another webinar I did for the Principles for Responsible Investment in collaboration with ECGI and NBS last year. And there I focus on three main messages. One, sort of the ESG 1.0, which would be looking at ESG scores, how many investors align their actions with their principles, and whether there's instances where they might not walk the talk or sort of greenwash. ESG 2.0, I looked at portfolio carbon footprint, something I'll come back to today. And in particular, if even in investors, climate conscious investors walk the ESG talk and green their portfolios, they might not be helping achieve the broader goal of greening the planet. And so today I'll be focusing on what I call ESG 3.0 by looking into green revenues and the green transition, and present preliminary evidence looking at those actual green revenues. Now, I'll try my best to be evidence-based, and I'll leave you here some quotes on the importance of being a skeptic and being evidence-based. So ESG investing has been a lot in the news over the last few years. Back in 2020, when I first embarked on this journey, and I wrote for the CFA Institute a review on ESG and responsible institutional investors around the world. What Laurent mentioned was my core research. ESG was a rising trend, and here's a bit of its backstory. And by the time this came about, ESG was actually the year of ESG was 2021. There were record inflows into ESG funds. A lot of green stocks were doing very well. There were new regulations coming out from the EU and other geographies. But things have played out. This topic has become more controversial. For example, The Economist has labeled, ESG as the three letters that once saved the planet, and they called for the focus to be more on the the environmental dimension. ESG became, had a little bit of slowdown and outflows. There was a market correction also due to other focuses on, Ukraine, geopolitics, high inflation, and some pushback, in particular across different states here in the US. You see here a map of anti-ESG state policies. The backlash is summarized very well if you have the extra time by watching this video the Financial Times put out about who killed the ESG party. But I'm going to focus today more on, some of the, particularly on the green lash and the backpedaling that's, happening as we speak on this transition to green. So for example, the CFA has relabeled its original ESG certificate to sustainable investing certificate. BlackRock has relabeled from ESG a lot to transition investing. And it's finding itself in a hard spot between, what's happening here in the US versus what's happening in other geographies like Europe, where some of the clients are still keeping a focus on ESG-oriented mandates. So a lot's to discuss here about, whether we're seeing the end of ESG or is ESG actually coming to its core and we are starting to tackle real interesting problems. And the reason I'll talk about the E in ESG today, arguably the most significant component of that being climate change, it's that we live in this sort of cognitive dissonance where we get this mixed signals. In some reasons to be pessimistic would be, decarbonization, reduction of carbon emissions. The world is on track to exceed the Paris goal of 1.5 degrees Celsius over pre-industrial levels. As you can see there on that first chart from the Financial Times, there's been lack of progress, for example, in COP30 in Brazil. Just a couple months ago, the US is pulling out from the Climate Accord and other international organizations like the IPCC, etc. And at the same time, you see this, UNEP emissions gap report saying there was a small dip in emissions in 2020 during the COVID lockdowns, but it's coming back up. And the trajectory is not aligned with getting us to a net zero by 2050. So that's the half empty sort of glass, half empty type. Yeah, but there's also some half full glass feeling if you want to be optimistic. There's quite other signals coming that are positive. For example, this article from The Economist suggests that we've actually exceeded the ramp up in the growth in renewable energy from entities like the IEA, the International Energy Agency, and we're actually reaching cost parity also in electrical vehicles. And especially with the rise of China as the sort of renewable energy superpower, BYD, for example, surpassing Tesla on many, not just sales, but also things I'll talk about today, green revenues, but also in terms of the sheer speed of charging those vehicles, etc. The innovation that's coming out. That's really strong signals that are positive, and a lot of clean energy stocks are actually doing fairly well recently with all the energy demand that's coming from AI. So there's a lot of negative and positive signals. So as I said, the first few minutes I'll just spend on background on ESG and investing, but you can also go back to the PRI CGI website and see some of that. My journey, as I said, started by looking at the history, the definitions, the motivations for ESG. But the first difficulty I had early on was to measure how big is ESG. And ESG, if you start strictly from ESG labeled mutual funds, which a lot of academic research focuses on that would be a tiny drop in the sheer size of public equity and fixed income markets. So if you think about that as 230 trillion, only about 3 trillion of those assets are actually in ESG labeled mutual funds, according to Morningstar. If you take a broader perspective and use what's called the Global Sustainable Investment Alliance, which includes pension funds and other insurance funds, sovereign wealth funds, other institutional investors that hold sustainable assets, then they have mandates that are, you know, maybe like 30 trillion. And if you take a wider perspective, there's principles for responsible investments that a lot of signatories pledge to. That is a growing number, you know, over 5,000 signatories now, over 100 trillion. So despite all the academic research I was reviewing at the time, the actual extent to which adoption of ESG was quite unclear. So I decided to look back then, you know, before all this movement started, you know, how big was PI, and particularly all the signatories will, you know, sign to principle 1, which is to incorporate ESG, principle 2 to be engaged owners, etc. And most importantly, principle 6 is to report data. So I examined the 2019 reported data. And what I found is, you know, as this was growing, a lot of signatories were European investors. This is some of the list of those investors and some statistics back then. Again, I'll refer you to the my review back in 2020 if you want to look at the specifics. But they implemented ESG in various ways, you know, by selecting stocks or fixed income or other investments. If you think about stocks, which assets to buy, which stocks to buy, or which stocks to sell, there's really a lot of strategies here, you know. Negative screening, avoiding controversial stocks. So that was the most popular strategy when we looked at the data. But also what I'll talk about today, which is thematic investing, focusing specifically on stocks that do renewable energy or, you know, water, electrical vehicles, etc. Back then was quite niche, which is in blue here. And it's relevant to what I'll talk about today. But a large fraction of the signatories were reporting more what you see here in green and orange, which is integration, so research, valuation, portfolio construction of using ESG data, or engagement with the portfolio companies, trying to make change in the portfolio companies. But it was hard to assess the impact. So that's what I looked in the first paper with my colleagues here at Darden and the University of Geneva that was published in the Review of Finance. And what you see was a growth of you know, institutions pledging to these principles, particularly outside the US. And then our research combined different data sets, you know, what they were saying in the survey that they filled back to the PI, what their portfolios look actually using FactSet data, and then ESG scores. As I said, ESG 1.0 from ESG data providers like MSCI, Refinitiv, Asset Force, Sustainalytics. And then we compare their ESG portfolio score for the aggregate positions in their portfolios, compare them to their peers, to the non-signatories, and see if the signatories were any better. So the curve there should suggest that PI signatories underweight the bad ESG firms and had more better ESG firms. But this result was not true around the world. So this was true on average, but not in the US. And particularly in the US, signatories perform worse in terms of ESG integration. And that does raise the concern of greenwashing, of not walking the talk, you know, pledging to these principles, but then not really forming their portfolios according to the principles. Our research was featured in The Economist in December 2022. The title was a bit strong, but the key message is to keep an eye on and keep a healthy dose of skepticism as you know, on ESG claims. A lot of academic literature here. I leave this just for if you want to catch up on other contemporaneous studies, other studies on impact washing by banks, also by corporations, and conflict of interest among ESG rating providers. There was a lot of, you know, movement as well in terms of greenwashing scandals, you know, that spurned not just in, you know, in the US, but elsewhere, a lot of voluntary standards, including from the CFA's disclosure standards for investment products. And importantly, what I'll talk about today, which is regulation that came out of the EU, particularly this creation of the EU taxonomy, which I'll present the research on, to keep people sort of going from greenwashing to tackling greenwashing. And, right now we're, sort of in the recent, discussion about greenwashing or sort of pulling back and greenlash. So a lot of concepts here, but so as we saw greenwashing, the next question is, well, even if you walk the talk, would that make an impact? And specifically what we looked at is tackling climate change and achieving this decarbonization. So I'll briefly talk about another project that was just work in progress at the time called Decarbonizing Institutional Investors Portfolios, also with colleagues here at Darden and at the University of Geneva. So decarbonization is this, this goal ideally would have been addressed with a global carbon tax, where economic agents would then pay cost to pollute, but it's been very hard to get this global coordination. So what's happening, it's then being pushed to markets and pushed to the finance sector, to institutional investors, since this have a growing share of the companies, including those high carbon emitting companies. So as we focus on two particular initiatives, the Climate Disclosure Project, which is to try to seek corporate disclosure to get to measure carbon emissions, but also decarbonization targets by the corporations. And the second initiative that came out later was then Climate Action 100, which was to target the top 100 emitters, became 100 plus, including other emitters, and then engaging with those top polluters. And in the paper, we examined whether those climate conscious investors, the CDP CA 100, are decarbonizing their portfolios, and if so, how? And how are they achieving that decarbonization? One challenge from the get-go is that a lot of emissions reside outside public markets. So of the $50 billion, gigatons of emissions that come from human caused emissions, industrial activities, only about a fifth or 10 billion of those gigatons are actually coming from publicly listed companies. So there was the challenge is lots of tests in the paper, and I'll just give you the punchline, is if you compare these two figures on the left, institutional shareholder on the bottom, in terms of the market capitalization, is growing from 41 to 50%. So institutional investors are becoming increasingly the largest holders of shares in that floated in public markets. But at the same time, the top panel shows you if you proportionally give, if an institution owns 1% of a company, it owns 1% of its emissions, then you actually see it's the emissions that institutions have in their portfolios, the greenhouse gas footprints have increased only from, have stayed flat at 9% instead of growing from 9 to, let's say, 15% if you use the same math of their ownership going from 41 to 50. So this indicates that institutions are actively decarbonizing their portfolios, so they're pushing, if you like, their emissions to some other investors out there. And so in our portfolio, in our tasks, what we do is we look at how you decarbonize your emissions, and you could be decarbonizing with two strategies, what's called reweighting, by moving your weights portfolios from brown to green stocks, versus what's called greening your the planet, which would be engaging with the brown companies to make them less brown. So those two strategies, and the strategy that dominates in our empirical findings is the greening the portfolio. So you're basically pushing away those brown companies, those heavy polluting companies outside of your portfolio. So pushing it to other investors. And that is, leave you here as well with some academic references. But that is basically the motivation for us to now look at the green transition. So if investors are, pushing away those emissions, how can we even, address this problem? And are we actually supporting the companies that are moving away from carbon and creating alternatives to? So let me turn to the main focus of the webinar, which is this study, still a work in progress, on the green transition, and which is co-authored with Johannes Klausmann, who's moved from Darden to University of Houston. He was a postdoc here. And then with me, and then Philip Kruger, who's my main co-author along a number of those studies I mentioned, who's based in the University of Geneva. So the transition to this low carbon, resource efficient, sustainable economy has been slow, as I mentioned. So the key we're trying to address is how fast are we actually greening this economy? And what we'll try to answer in this paper is, does it help to have things like the taxonomy, which is a policy tool that's different from the carbon tax or from other policy intervention that is defining activities that are green versus activities that are brown. And I'll walk through how this green classification systems work. But the most prominent of those, as I mentioned, is the EU taxonomy of sustainable finance that was published in 2020, and it's been now enforced the last 2 fiscal years, 23 onwards. So the question is, have firms actually, transition? Do they have the technologies to do so, to commercialize those solutions? And in particular, we'll look at the role of, green patents. There are other work on this topic here as well. And then, are investors willing to finance the transition? That will be our second question. Do shareholders stand to lose, or will they stand to win from this transition? So we look at, in particular, this new data on green revenues, which measures the percentage of green revenue that comes from green products and green services. It's from FTSE Russell, which is now part of LSEG. And it's company-specific estimates that come from corporate disclosures, but also, if not, then it's estimated. And if, by a team at LSEG, it's very good because it goes back to 2008. But as I said, right now, there's a lot more disclosure. So the data becomes more, assured by companies as they put out those public disclosures. So what we're trying to see is if this, forward-looking measure of a green transition has more information than what I've shown you before. The ESG scores that was informing the first wave of research in ESG, or the carbon metrics, which are a little bit more backward-looking. It is the outcome of previous production, processes in place, etc. And ESG scores are also more a measure of conduct. How is your environmental, social, and governance footprint, rather than forward-looking how you're going, how it's what's coming in the horizon. So let me tell you, what that would be. So by this taxonomies, as I said, started in the EU, but they're spreading all over. I'm involved with the Principles for Responsible Investment. I was actually in Canada in 2024 when the Finance Minister, Chrystia Freeland, was announcing Canada's taxonomy. So, more recently, Canada has joined also. In this past fall, Brazil was announcing its own taxonomy, leading to COP30. This is a picture I took actually around the event in Sao Paulo when they were announcing it. On the other hand, there are other geographies that decided to abandon this, like the UK. And of course, the US does not have a taxonomy, and many other, geographies here do not plan to have a geography. Now, there are efforts to make those taxonomies enter operable, so that there's sort of a convergence. But I would say the EU was the genesis for the most part of this movement. So the first question is sizing the green economy. So we look at, on the vertical axis here is of the 100% of corporate revenues, how much come from activities that we would call tackling this, environmentally sustainable goals that we're achieving. Not only climate, but other, resource efficiency, etc. So of the 100%, what you see is this chart going from 4 to 6%, or 6.5% to be more precise. And now I'm going to be slicing that into different sectors. And there's a big takeoff you would see there around the, post-Paris, the Paris December meeting. So the first three things I'll mention is, which is common with the EU taxonomy, is the energies. Energy comes with not just equipment, so wind turbines, solar panels, and you see some European players here and some, Asian players here, but also generation. So, once you start producing electricity from solar or wind farms, from hydro plants, but also nuclear, like in the case of EDF in France, as those revenues switch from carbon, so, coal or gas powered, or other forms of carbon heavy energy towards electricity being produced from renewables. And then finally, IT and cloud computing. And why do we count, the revenues of Amazon or AWS to be more specific, or Microsoft Azure, is because instead of me, traveling to the French Riviera and doing this talk at EDHEC, it's actually more sustainable to do, remote working or use Zoom in this environment. And that was at least the idea back in 2016, 17, when these things were being defined, leading to the publish of the EU taxonomy. Of course, right now you could argue, IT is very energy consuming, so there's actually an active debate whether we should count this as green revenues or not going forward. The other segments would be, sustainable agriculture, sustainable plantations. Those are very little represented in public markets. So food and agriculture is very limited. And I skipped also environmental support and resources, so like the minerals, lithium or other essential minerals for the transition. And then another big chunk would be transportation. So you think about like electrical vehicles like Tesla and BYD, as I mentioned before, or railways like Alstom in France, and as well as pollution control, very limited in public markets, or water infrastructure, again, very limited in public markets, very few pure plays. There's actually Veolia, but very few. So overall, this has now grown to about 6.5% of total corporate revenues of firms that are publicly listed around the world, totaling about $4 trillion, which is comparable to the size of the oil and gas sector. Of course, oil and gas, fluctuates with oil prices, but the green economy is sort of catching up, as this chart is showing. And here's a different visualization. If you take the, just one particular year, 2022, and break down by the different subsectors, there's a lot more granularity to the data, like Tesla having 100% green revenues, because it's not just electrical vehicles they sell, 93-something% of their revenues. It's the other 5 or 7% of their revenues that come from solar panels, battery storage, etc. Versus companies like Toyota, where we only count 30% of their revenues because it's only their hybrids and electrical vehicles. And then, other for railways would be, electrical railways for Alstom, etc. Perhaps more controversial, as I said, IT and cloud computing, or heating for real estate. These are, we'll call this tier 2 because they're not so green. So another way to color this chart is to color it based on the greenness of the technology. So dark green would be green products and services that have a significant and clear environmental benefit, and medium green would be more limited net environmental benefit. So cloud computing is a bit more controversial, as I said, or hydro. And light green would be those that have overall net neutral or even negative. So they could help be carbon free, but they could have environmental consequence. And so one example would be nuclear, with nuclear waste or water usage, etc. The same goes for minerals. As you extract lithium and other things, you have environmental externalities that come from that, or agriculture and so forth. So here's the green economy by country. US and China is leading in total green revenues, in dollar green revenues, but proportionally it's higher in Europe. And in this paper, we provide some more evidence for Europe, how it's took off after the creation of the technical expert group and then the implementation of the taxonomy. The green revenues by industry, as expected, higher for utilities, for transportation sectors, for manufacturing, but not all economy can go green. Example would be in healthcare or services, where the planet really doesn't care if another human provides another service to another human, but the environmental consequences are limited. The real, carbon heavy or environmentally impactful sectors are utilities, transportation, etc. And again, this is taking off not just in tier 1 and in tier 2 or tier 3, but it's also growing in tier 1. So it's across the board. So I'll just give you a couple punchlines on the paper and leave you for, if you want to read more, the paper is available online. So the first question is, what's driving? So we use this data. If the companies have from our own global corporate patent database, which I created years ago, and see if companies that had green patents walking into the Paris Accord, if they were able then to, with the Paris shock, to scale up their green revenues, or take to market and commercialize those technologies. So, as academics, we like this regressions with absorbing a lot of fixed effects and so forth. But we also sometimes do what's called difference in difference tests. And this is what I'm showing you next in this chart, whether you have some sort of parallel trends where each company is compared with a green patent is compared with companies without green patents, to see if they were behaving the same way leading to Paris, and if there's a difference post-Paris. And what you see is those with green patents commercialize their technologies faster. We provide a bunch of additional results, how this phenomenon is concentrated in the US listed companies. We look at whether there's substitution. We don't find much substitution from green to ground. It's just green seems to be scaling. We do some placebo. Looking at other types of patents, don't seem to correlate. And we also look into energy sector, and which is interesting because it's not all sectors that are greening. Certain sectors are actually not greening. And one example would be the oil and gas sector that as I showed you, may not have an incentive to green if it's cannibalizing its own, core business. Second question we ask is if investors are willing to finance this transition. So we combine the same data I showed you before, this FactSet institutional ownership data, and these two initiatives, the PRI initiatives, which I talked to you about, which goes back to 2006, and its creation of the CDP, which was supported by PRI, of getting companies to start reporting carbon emissions, etc., carbon targets and all that. And we basically codify if investors were part of PRI or not, or if they're part of CDP or not, year by year. And we look at how much investors pre-Paris you had that had already joined PRI or CDP. And if you had more of those investors, do you see a larger takeoff post-Paris? And they seem to be more aligned, right? So climate conscious investors, CDP and PRI's responsible investors seem to be associated with green revenue. So the final question, there's more robustness in the tests in the paper. The last question is whether investors value this green revenue. So it's a very hard question to answer because there's been still fairly limited time. But what we ask is, if the green stocks have outperformed. So we look at this question of what's called green alpha by forming portfolios of green stocks at different thresholds. A portfolio of companies who achieve at least 0% of positive green revenues, then 20% or above 20% plus green revenues, 50% plus green revenues. And then what you find is this outperformance of the companies that are more green. But, be mindful that it didn't really take off exactly in Paris. So we're looking into that in some more preliminary tests of announcement returns around Paris. And it seems to correlate more in 2020. And a lot of things happened in 2020, COVID, the taxonomy, and so forth. And it seems to be concentrated as well, mostly in the US, as I will show. A large part of it being driven, by one stock. So when we, did a more comprehensive test controlling for other asset pricing factors that are common in academic literature, so taking out market value, momentum, profitability, etc., and forming a portfolio where you go long the green stocks, those with green revenues at 0, 20, 50, or 80%, and shorting the legacy companies, the companies with no green revenues, going long short this. We compute the 5-factor alphas for both pre and post Paris. It's portrayed here in percentage per month. We find these positive alphas only show up in the extreme portfolios, the super green portfolios. And then in the test, we show that in the paper, we show that this is concentrated in US companies with higher green revenues. Now, there's a big thing in the paper about excluding Tesla. In particular, we still find the results in the US, even if you exclude Tesla, because Tesla goes from 0 to 1 trillion of market cap during our sample period. So it starts dominating this value-weighted portfolio. But we also test using equal-weighted portfolios to see if this holds true more generally in the US. And it holds true more generally, particularly for companies with high green patents and companies that have high institutional ownership, as lining up with our previous results. But this is very much work in progress. Lots of other papers. I just leave a few here for those interested, if they want to read more, other active work. And if I can finish with one last thing and turning back, look for a conversation with Theodore and Niall here. I want it to be a bit more speculative in the end, which is this question of, we are sort of seeing some movement in terms of the green transition up to like 6.5%. Maybe it's not sufficient to hit the 2050 goals. Actually, the EDHEC has an estimate that we would need to be, our economy had to be 20% green to become so. There's some debate about what that number has to be. But, we're only going from 4 to 6, so maybe not growing too fast. But at the same time, other things are happening. So we're in particular on the verge of another industrial wave with AI. So, we're seeing this clean tech, as I talked about, but it's also, coincides or not, maybe that's just how it goes, that you now have a greater usage of energy that comes from AI. So this morning, actually, 2 things caught my eye in the Financial Times, which is, like how the West was, falling behind in this green tech race. And the other article that was very interesting is how Microsoft was saying how they were seeing, China pulling ahead as well in AI. And so lots of big questions here about whether AI can ruin or save the planet, but we're still in the first innings. But very interesting to see, whether the demand for energy that's coming from AI and the fact that a lot of this value chain is now being concentrated in China is a good or a bad thing. So it's very much, I think, what we should be working on next, and calling for others to do research on this. And just to close some advertising, it's join if you're interested in these topics. You can also join the PRI academic network. I'm leaving here the website, unpi.org, and then navigate your way to the PI academic network. We hold both those events, like the one I mentioned in Toronto in 2024. Last year was in São Paulo. Some pictures here from last year. This year, actually in October, will be in Amsterdam. But we also have an online series, so feel free to join us online. This morning, we just had actually literally Marcin Kasperczyk, and I'm pulling a couple slides here, and he talked about not being hostage to just having one best metric. It's better not just have one metric like just ESG scores or just carbon metrics or green revenue share. There's a fallacy to do those. So this was recorded this morning, and it will be available in our website. And also this misconception that maybe markets will necessarily figure it all out, which I was speaking to as well. But I just wanted to advertise that our next speaker in February the 10th is actually going to talk. It's going to be Johannes Strobel, and he's going to talk about biodiversity and other topics in this as well. So keep an eye on as well on those events. So merci. I appreciate that you allowed me to do a little bit of advertising as well, and I look very much to the conversation with Theodore and with Neil.
Thank you very much, Pedro. Very enlightening, and also maybe we can do our own motion, because next speaker for the speaker series is going to be René Stulz next week, and he's going to talk about the listing gap. And I think it kind of relates to what you're doing, because you're saying that you only look at publicly listed companies, and in his paper he shows that well, in fact, most of the companies are not even listed, and so there may be things that we don't count, that we don't see, and that have a huge impact on these topics. So maybe we can start from there, and then well, Theodore and Naila, I'm going to close my mouth and let you handle this this conversation. But with respect to this kind of listed, unlisted companies, and what impact can we have? Do you have any insight?
Yeah, and I will actually backtrack a bit to my other paper here. As I said, there was let's see if I can make this bigger somehow. This was kind of what I was trying to show before, that there's if you look at carbon emissions, even if you take a company as big as ExxonMobil, that is still fairly small in terms of total emissions that come from a company like that. Or if you take RWE or Uniper, German utility companies, airlines, other, etc., and combine in public markets, the emissions are small. So in our other paper, we actually were let's see if I can do this, because we were looking at that as well, like in terms of what emissions reside in public markets and what emissions reside outside public markets. So a lot of is empty, meaning it's somewhere else, as you said, Laurent. And the ones in public markets, like let's say if you look about Saudi Aramco, for example, or PetroChina, or Petrobras in Brazil, a lot of those are held by other investors, not necessarily by institutional investors. So that's what's coded in this, checkered parts of how much is by other investors, other minority, and so institutional investors end up holding the less carbon intensive companies. So if they decarbonize, then they're not helping much the global problem. The same goes for our research here. What I'm looking at is only for the public markets, the green revenues that are coming from public markets. So I agree with you that a lot may reside outside public markets. I don't know that I cannot do as much the same math for green revenues as I could do for the total carbon emissions, because I can compare global emissions to what's in public markets. But I hear you that a lot of it may be, as we see it, decarbonizing, meaning pushing carbon emissions from public to private, like towards, but also but the public markets can be helping greenify by maybe financing the green revenues, but I don't have all the data to answer that question. How much of this innovation is coming from public versus private markets? But I think that's a very interesting, as a system, the market, I don't think the planet cares as much if it happens in public or private markets. It's about, like, us researchers being somewhat constrained to where is the light, where is the data, how much can we actually say? But Rene, I'm a big fan of that next seminar, and he's encouraged everyone to attend.
Thank you, Pedro. I think we learned a lot here about the transition, the energy transition. My first question is, I'm looking at the results of the paper, and this whole political environment you were talking about, and of course, the concern that some people, especially in the US, have is how costly is the energy transition. And I'm trying to look for some clues from your paper. And at least from the results that I see, it doesn't seem to be costly based on the findings. If I'm looking into your results about, let's say, the performance of these companies. So do you have any idea if this move towards more green revenues, as small as it is, whether it comes at a cost, or maybe consumers are willing to bear that cost? Maybe the cash flows are not impacted. Maybe it's possible that investors become more green and they price more favorably these companies, like in this Pasteur and Stambo theory. I'm sure you're aware. So is there anything about the cost that we can say here?
Yeah, that's great. So in the chart I show to make your point you just said, there is no cost in the sense that there is no evidence of a negative alpha, let's call it. Right? If anything, there's a positive alpha, although the positive alpha then is concentrated in US stocks. So actually, where we call this the Roy sorting effect, where it is not being pushed down like in Europe, where everyone has to greenify. It's not being pushed by the government, by the regulators. It's being, so maybe European car companies will stand to lose, and shareholders in those car companies will stand to lose. But there are other car companies that come about, like Tesla, right? And the question you pose is a good one. It's hard to answer with this limited this limited time. Is it that the market then became surprised that Tesla started generating all this free cash, all this surprising earnings? Or was it the market started revaluing those cash flows and discounting it differently, as you said?
Exactly, that's a possibility. Yes.
Good question from Pasteur and Stambo. So at a cost to alienate some of the students here, I'm just going to show you what we find in the more academic, in the academic. Are you able to see my
Yes.
PDF?
Yeah.
Yeah. So basically, what we do in this, as we break this down, is look at subsamples. As I said, exclude Tesla. So we exclude just one stock because Tesla becomes a big chunk of this portfolio. So this portfolio of extreme green revenues grows from 250 to 2 trillion of total market cap, and half of that is one stock. So we wanted to at least exclude that. So we exclude Tesla, and the results are still like statistically significant there. Or we would equally weight. So there are other companies, Waste Management, Enphase, other US listed companies that have also outperformed. But more importantly, this alpha, where is it coming from? Is it because the market was surprised by the revenues, or was it, to Theodore's question, or was it that there was just the market revaluing, which is what Pastor and Stambau do in their paper. So we look at those two things, and as we speak, it seems to be there's no evidence of earnings surprises so far. It's been mostly through this cost of capital or this sort of discount rate channel. And then we look at also climate news. I know, Tudor, you've looked into some climate news yourself in
Yes.
some of your research. So you may give us more direct feedback on this test. We use this index by RD et al., which
Yes.
you may be familiar with. And so
Yes.
we correlate the alpha, but just be mindful that this is only 192 months, right? So for an asset pricer, maybe this is not sufficient, as a test, because we've only have sort of the first period of the transition. So
Yeah,
I'm all ears if you have suggestions, how
why
else
I
to do
ask you
this.
for this is because it's important to think whether this trend is going to continue, right?
Yeah.
What are the implications? Because if indeed it's not costly for companies, I think we have reasons to be optimistic, right? From these findings, because
Yeah.
I know you said the revenues are going up, but we're still at 6%. So
Right.
maybe we want, of course, to go them up. So I think it's a very, very big.
Maybe as we go from 4 to 6, not costly. As we go from 6 to
Exactly.
10, and then from 10 to 20, then we may. So if as we speak, the U.S. has unleashed this some other way, not through regulation, right?
Yes.
So there, Tesla is clearly. China has unleashed this completely, as a central planner almost, like by empowering all these companies. Now they're competing too much actually in China, like BYD, Chile, etc. And Europe is preventing, with tariffs and other things from importing this. And now Europe is also, reconsidering its taxonomy. It's actually simplifying its taxonomy, and because people are arguing it's too costly. So, the context is moving. So, right, what I could show you in those first few years may look different going forward, because so many forces are, moving as we speak. So it's hard as an academic to, make this, attribution or this causality from each of these things.
Yeah, from an academic point of view, it's good to have, these changes in political sentiment, because it allows us maybe in a few years to assess how that impacts actually those questions. So there is something positive here.
Yeah, and down to earth. So you show that there is a kind of takeoff after the Paris Agreement, but we know it takes years to launch a new business or to do things. And so what is behind? Do people think that they are going to be more regulated, so they have to invest in this kind of directions? Or do they really consider that it's going to become profitable to be green? Or what is going on? Because it takes so much time, so much effort, so much investment, even though it seems that oil and gas company could simply use their patents they are not using. That's something that I try to retain from
we show. Yeah. So good question. So a couple thoughts. First, the reason we looked at patents back in the day, pre-Paris, is to see if they had done those R&D, the technological development pre-Paris, like had they did they have the capabilities to do so? But as more data comes out, now we can actually look into CapEx, green CapEx and green OpEx, etc. So the taxonomy not just gives you revenues, which is what we use in this paper, but we are already starting to process the other data that's coming from the taxonomy, which is the CapEx. But it takes years for these things to take to market, right? So yeah, very excited to start looking into that. Just on the energy sector in particular, I don't want to bore you with more results, but you can find those results in the paper. We didn't see the same results for the energy firms. So they did have the green patents, and there's other work by Laurent Cohen, Umit Gurun, etc. But the question is whether they hold it preemptively, like to prevent others from coming in, to protect their market, or if they will actually take to market. And we don't find them, sort of taking to market. So yeah, so we need to study, all these things, and then finally, to Theodore's point, there's all this different context has different policy intervention and shocks happening as we speak. So yeah, you can tell from my level of excitement that I think there's a lot that can be done here, not just by people with no hair like me, but also by younger people. So I encourage your students and every others to pursue these topics.
So Niall, maybe you have a few questions as well that we are just using the floor to our own pleasure, but Niall, that you're going to be the one among the ones who are going to have to really tackle the issue even more than we do. So what is your stand on these things?
One topic I was quite interested in was your research around institutional investors as well. I know you mentioned that post-Paris institutional investors, which were kind of sustainability labeled, helped grow green revenues. And you also mentioned at the start around in recent years, of course, you've seen a bit of a backlash around big institutional investors kind of moving away from ESG and sustainability labeling. So just looking into the future, I was quite interested in whether you'll see if that actually is going to have an effect on green revenues.
Yeah, very good question. At the risk of outing my other projects and my co-authors, we're exactly starting to collect the investors that found themselves in this being pulled different directions. So we're currently studying to what extent, if you're managing money for Kentucky or for the Florida, for other pensions in the US, you get pulled one direction. But if you have managing money for Denmark or Sweden or UK clients, etc., then you may be pushed another direction. And how is it playing out? So for the investors, because I mean for the investment managers. So as the different asset owners, the end investors really are pulling you different directions. But this end investors can also be like, Theodore and others have used, for example, temperature or other shocks to their preferences as these things are playing out in different geographies. How I invest this intermediaries, the investment managers, institutional investors being pushed one direction or the other. So I don't yet have the results, but I'm very much working on that to see if the dominant, like in the US, if the dominant money is not what we call red or Republican money, if it's blue money, then you don't really care in the US. You get to do what the blue money wants, the more progressive money wants to do, the New York, the California pensions, etc. And the same, what European investors want. But if the Republican sort of pensions are the dominant money, then you might do otherwise. So we're trying to study, as this plays out. But as Laurent said, we should examine this question not just in public markets, but as also looking beyond public markets, because then certain activities then can be pushed out, to non-public markets. So I'm sorry, Niall, I don't have yet the answer, but I think it's really interesting to study exactly as it's playing out. And we can only, answer maybe some small questions each time. But I'm very excited, to continue to work on these topics.
Okay.
Yeah, I agree. It's really interesting given how fast everything is moving at the moment. I think I'll hand over to Laurent now, given it's 7 o'clock.
Yeah, already 7. So maybe just a question from the crowd. If I reformulate it, Pedro, do you see any kind of positive perspective in the use of AI in terms of energy transition? Because we see that it's consuming quite a lot of energy, but it could also save somewhere else in terms of optimizing things. So do you have any insight with respect to this question?
Yeah, very interesting. It's very hard to answer that question, but some industry leaders will sometimes say, this is going to, optimize grids and, also, transition some of our more carbon intensive activities through AI. That there's a possibility there, but at the same time, you see a lot of tech companies, breaking their sort of climate commitments. They're no longer able to get to net zero unless they use carbon offsets and other things. So there's really very early innings on this. I think one needs to start to get as much data to answer that question. I don't know that they themselves would know, because there's quite a kind of uncertainty here. But I don't think we owe it to ourselves. Like, if there's a kind of uncertainty on climate as well, right? So we have all this uncertainty from AI, from climate, but we should be kind of studying all the innovation and the developments that are happening in the space to see how it's playing out. A lot of it, as an empirical researcher, goes down to data, and sometimes will be a bit behind the curve in academia, because it takes us years sometimes to get at some questions. But if AI and other tools allow you to do this more real time, then please do so, and please teach me as well, how one can actually go and start answering these questions faster.
Okay. Thank you, Pedro, and let me reiterate my thanks to you, and as well to Theodore and Niall. That was extremely enlightening. And well, again, next session is going to be. Can I share as well? My God, yeah, I can do so. Next session is going to be by René Stulz on the listing gap, and we'll have it moderated by Enrique, and as a student we'll have Asad Hussein Shah from the RMSc in Corporate Finance and Banking. And even though this is very different, we have seen today that well, everything relates to everything pretty much in finance, and there is relevance there. So thank you again. Wish you a very good 2026 years, and let's try to retain the half full glass and say that we're going in the right direction. Thanks a lot, Pedro.
Merci beaucoup. Thank you very much.